Well, January's Federal Reserve meeting is only 7 days away, and no change is expected at the first FOMC meeting of 2026. Last week's U.S. inflation figures made a rate cut unlikely, with both December's headline and core numbers coming mostly in line with expectations. The Fed will be watching the release of its preferred inflation measure this week. The most recent PCE data available is from September due to the U.S. government shutdown last year. And November's JOLTS data showing layoffs at a 6-month low, and December jobs numbers showing non-farm payrolls eking out a gain and unemployment falling to 4.4%. Well, joining me as we kick off the trading week is Stephen Cates, financial analyst for Bankrate. Stephen, great to have you here and good morning. Well, first, last week the markets received consumer and producer price reports, but what is your take on the inflation figures that we've gotten so far, and what does it mean for the U.S. economy?
So the CPI figures that we've gotten thus far have been encouraging. It's good to see that we got confirmation that November was not just an aberration built off of, mismanaged data during the government shutdown. The fact that we have gotten that confirmation that prices are cooling, that is a good thing. I think consumers can take a sigh of relief there.
And at the January meeting, the Federal Reserve won't be releasing a summary of economic projections, but we will be listening to Powell's presser closely. So as we count down the days, what are you watching for when it comes to the PCE coming out this week?
Well, PCE is going to measure things a little bit differently than the consumer price index. So getting a little bit more into the weeds of exactly how that's differing, what's causing any changes compared to the consumer price index, it's going to be really interesting. The Federal Reserve watches both, but PCE, their chosen measure, is going to inform a little bit more about what they might do down the line. I think we're all pretty convinced that January is not going to have a rate cut. So this PCE number and those that follow are probably going to give us a better indication of when cuts may come, whether that's going to be in March or sometime in Q2.
Yeah, and we all know that Americans, as well as the central bank, are paying close attention to labor market data. So first, give us your response to the November JOLTS report and what it tells you.
So I think it's a bit disappointing. The JOLTS report, the payrolls report, those are showing that, we've still got a very slow growing labor market here. Now, it's certainly good to see that we had 2 straight months of positive payrolls growth, but job openings have fallen. They were below expectations. We're still seeing very low rates of hiring, very low rates of quits. And, that's indicative of both employers and employees not quite feeling comfortable with making any big moves. So ultimately, looking forward into 2026, we're likely to see a little bit more uptrend in both of those, but we're not going to necessarily get back to the kind of numbers that we saw a few years ago, the 160,000 plus per month payrolls growth, or the additional few million job openings that we saw even just a year or two ago. Those are not going to come back anytime soon.
Yeah, and while I have you here, we've been hearing about the no hire, no fire economy, but when we're looking at layoffs coming out from some of the tech firms, as well as the landscape out there from what Americans are hearing, and even when we look at the employment report, what the U6 figures are telling us, what does all of this mean for Americans who are watching right now and are concerned about the labor market?
So there's a few interesting things going on. One, we're certainly seeing that jobless claims, both initial claims and continuing claims, are low and don't necessarily align with some of what we're seeing and hearing out there on the ground in the labor market. So that is either indicative of the fact that the labor market is doing okay, or possibly just that white collar workers are not feeling it necessary to actually sign up for unemployment benefits. So those numbers could be hiding a little bit of the pain that's underneath. Overall, people are frustrated. The low hiring rates, the low quit rates are showing just a lack of confidence and really putting people in a position where if you've lost your job or left your job and you're looking for one, you're having a really, really tough time. The time that people are spending unemployed is stretching out longer and longer. And it's certainly making people feel frustrated, concerned, and anxious because we've whipsawed from what was a very friendly employee environment just a couple years ago to now one that is very harsh to employees who are looking for jobs or looking to switch jobs.
Well, Stephen, we will have to leave it there for today, but thank you so much for joining us on this Tuesday morning, and thank you so much for breaking down all the economic data points.
My pleasure. Have a great day.